Hello, unstoppable real estate investors. It's Star, your hostess, and it's Wednesday at noon Eastern. So, of course, here we are. And I have one of my favorite guests, Brian Fine. He and I go way back. We worked at Fortune Builders together, Mind Protein together, and then we both kind of left because we were mavericks and we needed to go our own paths. And go our own paths we have, and we are both thriving because of it. So Brian has quite a story, and I want him to tell it because, I want him to tell from the beginning, like how you were living in a basement and, all that, all to where you came from, because I want to show how where you can come from and where you can get to in a relatively short period of time. But he and I were just talking about the economy. And so we're going to just geek out a little bit on that and then get into Brian's story. We were talking about the possibility of rent control being considered in the United States. And we're both saying there's no way that's going to happen. But then again, you never know. There's a lot of things that have happened in the United States in the last decade that I'm shocked happened. So and then he said in Ireland, go ahead and tell them what happened in Ireland.
Yeah, so you guys,
this is good because he is in Pennsylvania, which is a landlord-friendly state, except for Philadelphia.
Pretty much.
And I'm in North Carolina, which is a tenant-friendly state. And so talk to them about what happened in Ireland.
So in Ireland, that gives us a really, really cool case study on what happens when there's too much government intervention in private practice or private property rights. So a couple of years ago, there was a big pushback that rent was too high and landlords were taking advantage. And so their legislature took action. They outlawed evictions. They outlawed rent increases. And then something really cool and predictable happened. 99% of all landlords sold their properties. So today, you will have, it's nearly impossible to get a rental unit.
You froze there for a minute, Brian. Go ahead and say that again.
So they outlawed eviction and they declared what rent was. No more rent increases, and they just told you what you would get for it. And all the landlords sold their properties. And so there's hardly any rental units left now. And so it caused a massive problem. Now they're asking everybody to come back, and needless to say, investors are not interested in that. So it caused a really, really large problem. Rent control as a economic solution has failed every single time it's ever been implemented. There is a active version of it in California, but the version they have is actually really light. It essentially says you have to raise the rent no more than 10% a year, but if you don't raise the rent, then you can't raise it more next year. So really, it just screws the tenants and forces you to raise rent more faster.
Huh, interesting.
So yeah, it's in the U.S. we'll see that kind of thing. It'll happen at a not even necessarily statewide. It'll happen in specific cities, in the coastal cities and such, that become more tenant friendly before anywhere else. And then in other areas,
destination places like Asheville is growing like California and Oregon and Washington have. It's a popular place in North Carolina.
I can give you a piece of data you can track for it. It's very easy. It's population density. When the population density gets over 3,000, that's about the time it's going to run.
And the surrounding area is like at 50,000.
Well, it's per square mile. So it's the density of people. And then usually within 24 months, you see the policies that switch to tenant friendliness.
And what's going on in Asheville right now, and it's interesting because I moved here and I have a California perspective, even though I moved here from Mexico. I was in California a majority of my life. And moving here, one of the reasons I moved here is it had everything on my bucket list, but also it was affordable to invest. Like I knew I could do what I wanted to do as an investor. And it was going to start with buying my own property. And I bought right before the pandemic hit. I was closing right within a couple of weeks of the pandemic hitting. And it was a seller's market, but wasn't crazy. Like, who would have thought a pandemic would have actually been good for real estate? But it was. And when I first moved to Asheville, I was renting a 2-bedroom, 2-bath apartment before I bought my house. And it was in a nice luxury complex for $1,350. That same exact apartment is over $1,800 a month, just 3 years later. And it is actually cheaper to own a home than to rent in Arizona, in Asheville now.
So that that's not actually true, and it's not really true anywhere. The reason being is it is very expensive to be poor. And as investors, we forget that a lot, because while we may be broke, most of us are not poor. I assume if you're listening to this call, you don't have the mindset issue of being poor. But if you're poor, and I very clearly remember what that's like, to buy a property, you need to put 20% down.
Yeah.
And that is
I know
unachievable.
that's the reality of why someone's renting and not buying, because it's a paradox. You're damned if you do, damned if you don't.
Yeah.
It's getting that 20%. But
It's-
from a strictly what I pay in mortgage and what someone pays in rent,
that is true.
I get a lot more for my money paying for a mortgage that I don't even pay for. Renters pay for. Yep. And then someone who rents. Strictly rent to mortgage payments. Yes, the reason they're renting is because they don't have good credit. They don't have the income. They don't have the 20%.
A lot of them, it's the largest rental pool today is millennials. And a lot of them are renting because they don't want to buy a property.
They don't want to be house poor. They don't want to be tied down. Thus, going into the area that I'm focusing on, and that's more affordable housing on your terms, which is tiny homes and more modular, or, going smaller and having less money going into your home and more of it going into your lifestyle. But enough of all that. We digress. I want to have it be all about you today, Brian. So I really want you to tell your story, because it's a fascinating one, and as well as the martial arts. But talk about where you were before you were a successful real estate investor. And I don't want you to leave out the part where you kind of had education in front of you for a while and you were taking it.
Yeah. I can do that. All right. So I got a job in high school, and I had the same job till I was 26. I was an IT guy. I worked that. I was considered very, very good at what I did. And then one day I showed up at work on my birthday and they laid me off. And so I was sort of devastated, because that was the first time I'd ever been laid off from a job ever. And I went home. It wasn't even 9 a.m. yet. And we had to apply for unemployment. And I went through all that. And I was used to, as an IT guy, I worked at a very different pace of life. I would fix about a dozen computers at a time. So I was very, very fast paced in the way I did things. So by 9:15, I'd already finished applying for all the unemployment stuff, finished all that. And I got a call about an hour later from a competitor of my previous employer and said, "Are you really a free agent?" And he offered me the exact same job that I just had, same hours, same everything, and I could start the next day. So I would have been unemployed for a little less than 24 hours. And I claimed mental health shock, and I said, "Let me get back to you." And ultimately, I decided that I would go back to school, because that was a dead end career. There was nothing to be made there. So I went back to college. And while I was doing that, I was very, very heavy in martial arts, and I would go training probably once a month. We'd drive 4 or 5 hours to a seminar somewhere and spend the weekend. Well, I was doing that with one of my friends, and on the way back, we're listening to the radio. Some guy comes on the radio and says, "Hey, I could teach you how to flip houses." And I wasn't paying too much attention. And my buddy goes, "You ever think of doing that?" And I'm like, "Yeah, sounds cool, but it takes money, and that's not something I have. That's why I'm bumming a ride off of you instead of paying for gas to drive to Maryland." And he said, well, I was thinking of doing that and I don't really have the time. So why don't we do it together? I'll front the investment and we can get into the business. So we agreed to do that. And I spent the next 2 years getting all this education, learning how it works, and not doing anything. I mean, absolutely nothing. Then we finally went completely broke. Had no more money. He had bankrolled me till that point. And it's like, we got to do something or we're gonna fail at this and we're all gonna have to go back to work. So we went out and we bought a house and we renovated and flipped that house. And I lost $93,000 on a $140,000 deal. Figure that out. By time I got there, we had already bought 2 other houses. So before we even realized we were taking that kind of a loss, we were well into the next 2 projects. On the second project, I lost $6,000, and that's my joke is that he had
Made progress.
well, my partner had bankrolled it with his retirement account, and he had $100,000 in his retirement account. I made sure I wiped that shit out. There was nothing left.
Oh, ow.
So we took care of that. On the third one, we made 40K, but we had to lose it first. And despite all the education, that stuff only works if A, you take action, and B, you actually got to listen to what they say on a case. Just a thought. The whole being coachable thing cost me $100,000.
Yeah, not being coachable. Because if you don't know Brian, he's an arrogant ass sometimes, but he's really a very smart guy that when he gets something, he's very enthusiastic and then he can become a guru at it. And so talk about that transformation. But I have a quick question for you. Did he ever get his 100K back?
Mm-hmm.
Eventually. Yeah,
and then I lost it again. And then I made it back again.
Yeah. So
I lost his retirement twice.
Because that's quite a journey of trust. And by the way, Brian will be the first one to tell you he's arrogant. We have a relationship. He'll tell you because he can back it up. That's the thing. He has a lot of confidence, but he gets that confidence from exactly what he's talking about right now. Taking action and getting the experience and really knowing what he's doing. And where does that come from? This is where we talk a little bit about your discipline and how martial arts has helped you in real estate, hasn't it?
Yeah, martial arts is just getting your ass kicked for fake until you learn how to not get it kicked for real. And you spend your whole life doing it because there's a lot of variables on that. And business isn't necessarily that different. A lot of
discipline, doesn't it? It requires showing up and practicing.
Yeah, you got to put the time in. You got to repeat it, and it's simple. That doesn't mean it's easy. And that's this business and martial arts. This business is easy too. Buy stuff cheaper than the money it makes you. Sell it for more than you paid. Done. It's not that hard, right?
Right.
Thus endeth the lesson. But that doesn't mean that's easy. So
go back to, okay, so we made 40K. We're still under, water 60K, but you have a relationship with this friend of yours that's bankrolled it, that he trusts you enough to realize, well, we're making progress because you grew. You lost 93 on the first, you lost 6 on the second, you made 40K on the third. So, and you got him whole again and lost it again and got him whole again. So talk about that journey after the third deal.
Yeah, so they're concurrent, right? It's not linear. We weren't doing them one at a time. And if you guys are going to run this business for real, I don't recommend you do them one at a time either. You just get some multiple projects going on. But so we started running concurrent rehabs pretty much consistently. And after that, we were following our systems. We did it right. And so while I took some losses after, you do enough of these and you will take a loss, I wasn't losing because I failed to follow the systems. So it was working out and we won a lot more than we lost. So over the next couple of years, we flipped about 100 houses. And so that was through 2017, 2018. I was real heavy into it. We did reach a saturation point I think it was 16. We flipped 36 properties in 1 year. I don't recommend that at all. The next year we did, I think 11, and I made more money. And not because the houses were worth more, but because of the overhead I had to take on, the logistics, the additional work we had to put into it,
Yeah, and I remember
and the
too.
tax bill. That
Yeah,
was
and I
brutal.
remember back then too, because that's about when I started working at Mind Protein and Fortune Builders. But I remember there was a shift where, and I want you to talk about this, when you realized rehabbing that you could make more money wholesaling. And then a few years later, you had the shift about passive income and rentals. So you've really evolved. So talk about that shift from rehabbing into what your mindset was about in wholesaling.
So the original growth plan we were educated on was wholesale first to make some money, rehab to make real money, and then buy and hold to retire. That's not the direction I went, and nor is it the direction I would recommend anybody go today. But we started out with rehabbing because we had the funds to do it, and we wanted to jump straight to that part. Plus, not for nothing, I tried wholesaling initially. I did not do it well. Not that I would have known that at the time, but it was a pretty big struggle. And even today, it would be it's not as easy as it looks. At least to scale. Could you do a wholesale deal here and then? Sure, fine, no problem. But to make that a reliable business model was a little bit more difficult. So after doing a bunch of rehabs, we had both the network, the reputation, and the activity going on that wholesaling became a viable business model for us. Suddenly everybody knew that I knew what I was talking about. So if we put a property out and like, hey, buy it for this, and this is how much it's going to take to fix it, they know I'm not full of shit. It's like,
Yeah,
oh
because
yeah,
you've done enough rehabs and you're thinking like a rehabber, not a wholesaler. And pause there for a second, and I want you to dig into that a little bit. A lot of the benefit that Brian had is that he started out rehabbing and knew what that took. And a lot of people start out wholesaling because it's an easier place to start. But because they haven't rehabbed, they really don't know what's involved and can cut on the analysis of a deal or get a little too greedy for their fee or whatever. So what do you think the benefits, the disadvantages are to someone doing wholesaling who's never done a rehab?
You just don't know what you're doing is really what it gets down to. You don't have the way we put it in I buy off wholesalers all the time. And the way we put it to them is, if you make them an offer before you talk to me, you'll ruin the deal and you'll lose it. Because they're negotiating from a place that they don't have a clue. They have to start with, what am I going to pay for it, and go from there. Trying to argue with me over what I should pay for it doesn't work. I write the check, I make the rules. You don't get to do that. So as a wholesaler, you have to start with your buyers. And most of the good buyers, like Pittsburgh's a city of about 1.3 million. There's maybe a dozen who are really good, reliable buyers that you could bring wholesale deals to every month and they'd buy them. It's a very, very small list. And what we all have in common is we would not let you waste our time. I got way too much going on I'm not going to coach you through how to figure out what a property is worth so I can pay you for it. So you have to come with a degree of competence on that, or you have to trust somebody enough to say, hey, here's an off-market seller, here's the address. What would you be able to do on this property? And we'll figure out what that number is and we'll tell you. And then you go back and your job is to negotiate better than that. And you get the difference. So that's a viable path to wholesaling, but it's you have to start with the buyer
Otherwise
and work
known as
down.
reverse wholesaling, which really is silly if you think about it being called reverse wholesaling, because with wholesaling, you should start with the buyer in mind, because that is your success as a wholesaler, right?
Start with the customer, then come up with a product every time.
All right. So then you shifted from rehabbing to wholesaling.
Not exactly. Wholesaling for us has always been sort of a sideline. We just I got more rehabs than I can handle. Here, take some. Even today, we'll have properties that we're taking down as buy and holds. Maybe they need some work or something, and I don't have time to get to them. Somebody wants it, buy it off me, and we just that's our wholesaling. It's just a side gig.
Okay.
It's now we do that side gig in bulk, so it's larger than some people's small businesses, but we've never really done it as a dedicated business model.
Okay. And now keep talking through your journey as the evolution of it.
Yeah, so what broke me for rehabbing, it made me completely reformed. I mean, my joke is rehabs for quitters. You're only a project or two away from never doing another one. We had 11 rehabs going on, and my wife was 9 months pregnant with our first kid, and my business partner's wife had just passed away.
Oh,
And so we were doing pretty good. I had lots of money in the bank, business going strong, and we hadn't taken a break in like 7 years. So we thought, okay, we got lots of equity in these deals. We're going to put the whole thing on pause for a couple of months. We'll pay the holding costs and everything. No big deal. We're going to take a little bit of a break. So we decide we're taking our break. I jump on a plane in Pittsburgh in the morning, and I get off at a layover in Detroit. That's like a 90-minute flight, if even. I get off the plane, my phone explodes. I have like 80 missed calls in 90 minutes. I'm like, what the hell? They're all from my partner. I call him, and he's like, check your email. We have a problem. And I check my email, and I have 11 notices of foreclosure on my
what?
properties. We never missed a payment. We never did anything wrong. I have tons of money in the bank. Hell, that's all set up ACH. I didn't do anything. So what happened? We had all of our financing for those properties through the same hard money lender. That hard money lender was bought by JP Morgan, who shut down the program. And because the way our note was written, it was a 6-month term, and they could opt to extend you for 6 months. They just denied all the extensions, which by default we'd used them for years. They'd never done that before, so it was a new behavior to us. So I called them, and I'm like, "What do I do? I have no idea how to fix this. I never did anything. I paid the mortgage, right?" And they said, "You need to get out. If you aren't refinanced in 30 days, we'll execute the foreclosure on you." So we had to go find the first foreclosure or first refinance we could possibly get as fast as we could. And as you might imagine, that's not the best one. So
Yeah.
across all those projects, we had to bring $500,000 to closing. Good
So you
news.
saved them all.
That was just the refinance. So to not get foreclosed on and have us financially destroyed, that's what we had to do. So good news was we had the money. Bad news, that wiped me out. I came home from that closing. I think I had $3,000 in the bank when I was done. And that was less than a month off. And so I'm sitting there on the couch with the wife. I'm like, well, I'll go get us another project. I'll find one at a nice deep discount. We'll get a little bit of cash up front here. We'll finish project, and I'll have us another $30,000 in 2 months, 3 months. And she said, "Are you a moron? We just worked for 6 or 7 years to make that money. And the moment we wanted a couple of months off, it all just went to shit. And all we've been doing is working a high-paying job that gets taxed as a high-paying job too. We hadn't built any wealth. I wanted a couple of days off to deal with the birth of my kid. It's not like it's a drinking Mai Tais on a beach, right?" And we couldn't get it. And yeah, some of that was timing and circumstantial, but it drove home the point that we'd spent all these years making money, but we hadn't built any wealth. We had failed at the very thing that when we set out, we said we wanted to do. And that was the last time I did a retail rehab.
And how long ago was that?
2018.
2018.
Yeah.
So then what?
Took us about a year to convert what we were doing. We got into a new partnership. Met some absolute genius people who had the same goals as we did. And then we started building a buy and hold portfolio. And so I have about 600 doors under management right now, and we've built up. And we're also a turnkey provider, so we help others do the same. And so what the direction we go now, as far as educating others, is we tell you to skip the wholesaling and rehabbing. Buy and hold. It's the answer all day long. You make more, you do less.
So the question will be for people who want to do that is, so how do we fund it?
Same answer is, how do you fund a rehab? How do you're going to use a primary lender to fund 70-75% of it, and you're going to use a partnership or a secondary lender to fund a gap. And there's no difference, except instead of having
The difference is terms though, and length, because with a rehab, maybe you're doing a rehab for
it's high risk.
months.
Yeah, it's high risk, high risk short term, so it has a higher inherent return to it. Though we talk about this with lenders a lot too, because I teach people to buy notes and invest in notes, and we do that with our own retirement accounts. Let's say you're getting 12% for your cash as a private lender. If I lend on a rehab to somebody, and let's say it takes them 6 months to do the deal, I got paid 6% of my money because it's an annualized thing, right? So now if it takes them another 60 days to find another project and close on it, and then I lend to them again, I only have 10 months of interest, so I get 10% back on my money during that time. And in addition, from a risk profile, it's much higher risk. Something goes wrong with construction, everything else, we can take a principal loss. As opposed to, we do a buy and hold note at 8%, 9%, but it's going to last for the next 5 years with no economic vacancy at all. So you gain stability and lose volatility, and it's just straight risk reward.
Yeah, so the type of lender you're looking for is someone who's not wanting to do, they want to do something a little more stable and a little more long-term.
Usually it's a phase of life thing.
Yeah.
So if you're we recommend you do this out of a retirement account because there's tax implications to that. And so you take somebody who doesn't have 20 years to rebuild a lost principal. If I'm at 55, 60, 65, then I would much rather have the stable return with a very, very low chance of loss on that than take the volatility for their higher hit. If you're 30, totally different game. You can afford to lose it and make it back twice before you have to go again.
Yeah. So those 600 doors, you and your partners own, or are you managing them for other clients as well?
Both. I own about half of them. I have about
Okay.
300 for myself.
And talk a little bit about how you some of your programs on how you help other investors with buying rentals, building a rental portfolio. And I know you're moving more into multifamily as well, because that speeds up the process.
Not exactly. No.
Okay.
So when we say turnkey, we mean that the property you purchase is rented or rentable within 30 days. So basically they're retail ready properties. We can go in different areas. We usually do middle class. We can also specifically do a few Section 8 markets that we like, that work depending on what you're investing in. In 2020, 2021, we almost exclusively did multifamily because it was the only thing that you could buy with a return. There weren't any single families on the market. Today, it's the opposite. Today we're doing almost all single family, 1 to 4 unit. And it's not that there aren't multifamilies, it's just the financing for multifamily really sucks right now. So dollar per dollar, you'll do much better in single family world.
Yeah.
But we provide, it's a one-stop shop. You come to me, you tell me how much you got to spend, and I'll spend it for you, and we'll get your return. So we'll set you up with the property. We'll set you up with the property management. We'll set you up with the lenders who do these kind of loans. We like low doc loans that are to LLCs, not individuals. So you don't have a limit on those, and they don't affect your debt to income ratio for any other kind of lending. You can get thousands of them. It's all good. So we'll set you up with all that stuff. All you do, buy the property, collect the checks. Make it easy.
That truly is turnkey. Yeah.
Mm-hmm. Yep.
Anything else that you want to talk about, discuss, share? Anything about
So well, this is probably a
your-
good segue into your economy discussion. Right now, for the last since March of last year, the Fed has been raising the rates, and that translates to higher interest rates across all our stuff. For you guys who are rehabbers, you haven't noticed too much. Your 12% and 3-point hard money loan is now 14% and 3-point hard money. Like, it's not really a much of a difference. You don't care. But for those of us who operate in buy and hold world, this has been a significant shift. We've gone from getting a 30-year mortgage at 4% to now I'm at 8.5%. And by March, I'll be at 9%. Most likely, just because of the way the Fed's head and everything. And what that's led to is the way we underwrite our properties is based on the lender, not on investors are kind of dumb. They want to underwrite for their return. That's not how we do it. We underwrite for the lender's approval. The lender won't let you buy a cash flow negative asset. Just hard rule. They're not going to let you do it. Nobody does that. They will lower the loan amount until it's cash flow positive. So our requirement is on a property is to be able to use the maximum loan amount. That is my strict requirement on it. 4 walls, a roof, and maximum loan amount. And the cash on cash return on acquisition is what in 2017, 18, 19, if you were buying a property, this is what you would have looked at, and you'd have been looking for 8, 9, 10% initial return. Today, it's 1.5 to 2%. Now, if that sounds pathetically low and you're no longer interested in this, maybe listen a little further. That's only 1/5 of the income streams. We have 5 different ways that rental property pays us. That 2% return in year 5 will give you an adjusted probably 20 to 25% per year on your money. And that's across appreciation, depreciation, rental increases, and some fun stuff that has to do with inflation. But it does take a bit of an education to understand how we're building wealth doing this as opposed to making money. Okay. You want to do, do I have time for a quick math problem with everybody, Rihanna?
Yeah, and
do
also,
it?
yeah, and I also want you to give them a little information on your martial arts background, and because that's a big piece of who you are and a big piece of your life. And also, I think it's also contributed to your success as a real estate investor because of the mindset that's required, but it's a big part of your identity. And this isn't just about having a discussion about real estate investing. It's also giving people a chance to know you. And it's about you as a whole person. So I'm interested in that too. But
Okay.
yeah, go ahead with the math problem first.
All right.
I'm learning all kinds of good stuff from
Let's
you,
say,
as I always do.
let's say you have $100,000. Okay. And we're going to use a unit of item you can buy for buying power. Let's use a cup of coffee, and it's going to have to be a gas station coffee, not a Starbucks coffee, because we'll say that this cup of coffee is $1. How many cups of coffee can you buy?
For 100 grand?
Yeah.
100,000 cups of coffee.
Easy math, see? It's who needs a PhD? We got this.
Yeah.
All right. So now we're going to turn around and we're going to buy an asset. We'll make the asset a house, but it could be a stack of gold bars or something. It doesn't really matter. So we buy a house for $100,000. And this magical house, and just for our example, we're going to keep it really simple. No closing costs, no nothing. It's 100 grand. Is you write the check, you own the thing. Some point in the future, could be 5 years, 10 years, 20 years, whatever, inflation has doubled. Coffee is now $2. And your house kept up with inflation. Your house is worth 200,000. You sell it. How much money do you have now?
Well, if we're keeping the math simple,
Mhm.
you know, depending on if you paid 100K
Yep.
and, you know, you had that money,
Mhm.
it's not a mortgage, you're not paying interest.
Yep.
You've made 100K.
Yep. Except we have our forced business partner, our good friends at the state.
And Fed.
Yep. And they're going to get their capital gain.
Okay.
Depending on where you live, that is going to be somewhere between 20 and 30%. Let's use 30 for just, again, easy math. So they will tax the difference between what you bought it for and what you sold it for. Your profit was $100,000. How much did you make after taxes?
70K.
Yep. So we now have $170,000. How much is coffee?
Coffee's
$2.
$2, yeah.
Yeah, because it doubled, right?
Right.
How many coffees can you buy?
With 170K.
Mhm.
Roughly, if let's see, once it 80, sort of 80,
85, I think.
85,
Yeah.
85, yeah.
Right. Okay. So you started out with $100,000 buying 100,000 coffees, and you ended with $170,000 buying 85,000 coffees. You made $70,000. Whee! You lost 15% of your buying power.
Yeah,
That's the part that most people don't understand.
right.
That there is a massive difference between the wealth, the buying power, and the making money. Now let's just very slightly change this magical equation. Same dollar coffee, same $100,000 house. This time we're going to get a $75,000 loan on it. And again, we're going to keep the math easy, no interest, interest only payments, whatever. So we're going to put down $25,000 on the house. Okay. And again, no, it's a little different than this when you factor in everything. This is just to make a point. Inflation doubles. Coffee's $2. House is 200,000. We sell it. We made the same 100 grand. We pay the same 30K in taxes. I made $70,000. Same as if I bought it in cash, right? But I made the 70,000 against 25. So I started out, how many coffees was I able to buy with my $25,000?
Well, starting out,
Yeah.
$1 a cup.
Yeah,
or
25K in coffee, right?
Yeah, 25K.
Now I have $95,000 in coffees, $2. I can buy 47,500 coffees. I've increased my buying power by 54%. So we made the same amount of money, but I netted much, much more and my buying power increased. That is because of inflation. Buying in cash makes perfect sense if there's no taxes and no inflation. As long as those two things exist, which unfortunately I think they always will, Franklin, death and taxes, right? That means that leverage is one of the most critical tools we have. The reason your returns look low when you buy stuff today is the leverage is more expensive. That doesn't mean it's less valuable. So, and you can play with that little math problem I gave you. The version with leverage doesn't need to keep up with inflation. It can be worth about 130,000 or so, and still increase your buying power more than if you bought it in cash. So that kind of stuff changes the way people think.
Yeah, and that's what you're educating people on. So talk a little bit about your programs. Your program, is it strictly the mastermind? Do you have portions of the coaching program?
Yeah, so we do a mastermind for for investors who want to build a large rental portfolio. And that is the we
What's
teach
your minimum requirement?
you got to be able to qualify for a mortgage. So credit score over 720. You need about $100,000 in investable capital. And you have to do a deal within 6 months.
They have to purchase something with you in
No.
6.
I don't care who you buy it off of. You got to buy something.
Okay, just
Yep.
within the 6 months that they start working with you, they have to.
Yeah.
Gotcha.
We don't force people to do business with us. I will tell you that pretty much every member of our mastermind does, but you don't have to. You want to buy something at home, go ahead. I don't care.
But for them to be in the mastermind and qualify for it, they have to take action and buy something.
Correct. It's or the deal's real simple. I charge you to be in the mastermind, and if you don't do anything, I keep your money and you're out. So it's fine. You don't have to do anything. Just I'll take it as a donation. But yeah, we do that. You do not have to be part of our mastermind to do deals with us. So if you want rental property, that's fine. Just come to me and I'll set you up. We got tons of that. We're doing equity deals now, which are kind of cool. If you would like to be a business partner with us on somewhat larger deals, we can do that. We begin that conversation at $200,000, and the assets involved are usually over $2 million. So I have a few of those coming up and available. And then we always we do private notes as well. So if you want a place to lend your money at 12% for 24 months, well, I've been doing this a while. We know what we're doing. We lack volatility as a place to invest. So
Nice. All right.
that's that end of things.
Yeah, I like it. It's so cool to hear how far you've come and how you've evolved, and and you're always looking for the next challenge, the next thing. And
we used to look at I mean, back when you and I met, I would look at the buy and hold guys. I'm like, I can make more money than them. Like I can go flip 4 houses and get a 50% return on my cash, and in the same time that they're getting like 5%. Now I see that's not quite the case. Not only do the buy and hold guys tend to make more, the risk of a loss is will set you back. And if you put a rehabber side by side with a buy and hold investor,
there's way more risk. Yeah.
Yeah, it'll tend
and
to
it's
be
a lot more work. I mean, there is work, but you factor that into the model with a buy and hold.
Yep.
And you delegate people to do that for you, and you build that into the cost. But with rehabbing, even if you have a team and you've delegated, it's still risk. It's still your risk.
It's also, we talked about this a little bit before you started the call. The real estate market is cyclical, and the cycle we are in right now is not for rehabbers. This is a terrible time economically to be rehabbing. For example, if you bought a deal in cash today and flipped it stupid fast, let's say you did the rehab by the end of this week, you list it and you accept an offer by like next Wednesday. So we're talking superhuman rehabbing, way better than you're actually going to do. But let's say you're this good.
Like home makeover on TV rehab, where they say it's taken a week, but it's taken them 3 months to actually do it.
Unless your buyer is a cash buyer, here's what's going to happen. By time they close, the Fed will increase the rate twice. And so their buying power will diminish. And that's going to put significant downward pressure on your sales price. So if I'm doing a rehab today, I'm probably knocking up, depends on the market, but probably 10% off the ARV to start with, just because of the cost involved in the financing for my buyer on the other end.
So in this market, in your opinion, which you're a researcher, you're a facts and figures guy, what is the best real estate investment strategy to be focused on in the market right now?
You hold. In any size, shape, or form you can. I don't care how you hold, but you hold. And the major reason is the Fed's going to cut the rates, and we're going to be back to seeing the market appreciation we saw in 2020, 2021. So to give you guys an idea, if you weren't playing this game in 2020, 2021, we could basically buy a property, not put a tenant in it, just hold it and sell it for a profit in a year or so. It was appreciating so fast, we could pull that off. We're going to get a lot of that back in a lot of markets. And so we don't need to sell the property to access that value difference. We can do cash out refinance. The rents go up right alongside it. The United States is about 7 million houses short, and they are not doing a lot to fix that deficit. So the supply is super low and the demand is artificially squished by the financing. As soon as that artificial demand squashing goes away, price will go up.
That's a technical term, artificial demand squashing.
That's what the Fed does. That's all the rate is.
Yeah, it's just, it is interesting to just like watch, for example, like the stock market, which, there's technical trading, there's, trading, different people use different strategies, but when it's all said and done, emotions affect it, reactions affect it.
Yep.
And people can be very analytical about things, but to not think fear and emotion and mindset factor in is being naive.
Yep, absolutely.
I mean, be prepared. Do your homework, know the numbers, know what you're doing, but our economy is affected by fear. It's affected by emotions, and it's weird. It's really weird when you step back and think about it. Like, isn't it? Don't you think so?
Yeah, it is. Though if we think of it as a sort of a chain reaction, the front of the chain is the stock market. So they'll react to like a report comes out, or something happens in the news, or a butterfly flaps its wings in a Ukraine war, and suddenly your stock portfolio takes a dive. Real estate is the other end of the chain. We're the last ones affected, mostly because we're a necessity. Somebody somewhere's got to live in a house, and
people have to work in buildings, live in houses. Yeah.
Yep. Yeah. So it makes its way down to us, but not as fast. Real estate, you can look at the supply and demand over years.
That's an advantage because you can plan ahead. You can see it coming.
Yeah. And that's why knowing we have such a massive supply deficit is so valuable. I cry a little bit every time we sell a property, because if I just keep it, we will make more.
If you keep it long enough, right? Yeah.
Yeah, we will simply make more. The Fed's going to give us tax deductions for holding it. Here's a thing. If you call yourself a real estate investor, then there is a requirement. You have to be taxed as a real estate investor. To be taxed as a real estate investor, you must hold a piece of property longer than 12 months. If you don't do that, you're an unlicensed real estate broker, unless you happen to be an agent, and then you can be a licensed broker. But that is how you are taxed. So according to the IRS, unless you hold property, you are not a real estate investor. So even as a definition,
like you said, it's back to a high-paying profession if you're rehabbing and wholesaling.
Yeah, it's also
not getting the tax write-off benefits.
Yeah, and it's taxed as income as well. So you lose upwards of, it depends on how much you're making and everything, but 30 to 50% goes away when you're a rehabber. As a buy and hold guy, there's some strategies we can use to reduce the tax bill to zero, but more commonly I run right around 7 to 10% of total taxes paid, so much lower than others. So we have all those advantages as well. Plus we get to make all the money long term, and we keep the property. One of the things, have you heard the term the churn? Do you know that one?
Mm-hmm.
So it's
explain it.
Yeah. So if I'm a rehabber, or a wholesaler, it doesn't matter which. I go find the deal, I do the deal, I sell the deal, and now I have nothing. So I have to go find the next deal. Having to find the next deal is the churn.
Yeah, you're churning away, you're grinding, you have to hustle. You got to keep things moving. Like you learned the detriment to that when you tried to take a month off.
Yep. Yeah.
If you weren't hustling and grinding and churning away. So it's one of those words that sounds exactly what it means. Churning away.
Yep. And it's not passive, it's active investing.
Right.
And when you actively do something, the return is higher, unless you want to factor in the cost of your time. And then the return may very well be lower. So with buy and hold assets, we can put in effort. As soon as we do the acquisition and have the management in place, you kind of stop. You don't really have to do anything else. You can keep actively grinding at it to build and create a larger portfolio, further reducing your risk, increasing your net worth, and all that other fun stuff. You can play as long as you want. But when you decide you've had enough, or if there's a change in your life and you have to quit, that doesn't mean you lost a thing. Properties doubled in value and you want some cash out of them, we do not need to sell them. We simply make sure that the income can handle the difference, and we refinance them, and you pull out all that money. If I sell that we did the example earlier of the house that became worth $200,000.
Right.
Let's say we own that property as a rental. Instead of selling it and making $70,000 after cutting a check for 30 G's to the government, I'll refinance the same property. A lender will give me $150,000 to $160,000 total for it. I'll get 50 or 60K tax-free because it's debt. And I keep the property. And in another couple of years, I'll do it again. The tenant will pay the bill. I don't really care what the mortgage costs, just so they pay it. Right.
All right. So there's some people watching us, Kathy Thornburg. Hey, Rihanna and Brian, giving you all a shout out from Portage, Michigan. Sevelin Smith, great one, Brian. Andrew Castine, boom, boom, boom. And Andrew Castine given a hashtag that I have no idea what it means. BAMAICAFAIC.
You got me. That's
Andrew, you'll have to explain what that acronym means. Dale Emery, good stuff, Brian. Stefan Mainhart is with us. Callie Haynes is with us. Hi, Callie. Hi, Rihanna and Brian. So, Brian, what I love about you is you just don't mess around. It's not fluff with you. It's dig in, meat and potatoes. This is what works. This is what's real. And I've always appreciated that about you, is that you're just no nonsense and you tell it like it is. And I'm no
at the end of the
nonsense and I
day,
tell it like it is. So
we're
I
all
like it.
here to. The purpose of our time together is generally to make money and to spend
And to
that
learn
money.
from each other.
Yeah.
And to learn from each other.
But we spend that wealth that we built living whatever life you want, whatever definition you have of that. For me, that's, hang out with my family and go over to Japan and get the shit kicked out of me by old Asian guys. But the whatever you want to do and to be able to live that life, well, you got to cut the bullshit and you got to go make the investment. The key word in real estate investor is not real estate, it's investor. You got to spend something. If you have no money, then you need to invest your time and energy.
Yeah.
And what you're going to invest your time and energy doing is finding somebody who has money, because that is the requirement to do a deal. There are such things as $0 deals. There really are. You are not going to build wealth on them. They are too damn rare. The chances of you getting one, if you've never done anything before, is vanishingly small.
Yeah,
we occasionally get one.
Are employing creative financing options. A lot of people, I think, misunderstand subject to seller financing. They think, oh, I don't need any money for the deal, so they don't build relationships with hard money or private money, and they think, oh, I'm going to go find a sub two. It is rare. Like I was just talking to a couple that are clients of mine, that they're actually one of these unicorn deals, finding a subject to for 3K. They're getting into a deal for 3K.
Yep.
Those, even if you do sub two, and Pace Morby talks about this, no credentials, no credit, no cash, but there's still money involved in the deal. And you can do creative financing, but you're going to the the reason you need to get good at raising capital is it leverages you to be able to do more deals. You know, I was
It's
talking to the
also,
same couple who wants to use their money to rehab. And I said, why are you doing that? Use your money to buy something, but use other people's money that's going to be put more at risk and in a rehab type of deal. So say
yeah,
a little more about that.
uh, you don't buy in cash, you certainly don't rehab in cash. If you can't at least get a hard money lender to stroke you a check for your purchase and rehab, that's not a deal. They're much better at underwriting than you'll ever be. They literally stake their entire business on it. So you don't have, if you can't get them to write you a check, you run away. Just run screaming away. That is not a loss, I promise. You do not want to have a hard money lender turn you down and be like, I can do it. That is not likely to end well.
Right.
And then getting into a $0 deal. If this is the only thing you've ever done, you've never done another deal before, and you're completely broke, and so you call around and you negotiate, and you eventually find somebody who is desperate or dumb enough to give you all their equity and sign over their property to you for a mortgage payment. And then presumably you're doing this with the intention of doing it as a buy and hold. Well, let's say you get into this deal for, what was your example, $3,000 or something that they're getting a
Yeah,
property for?
subject to with a gal that
Fantastic. Sounds awesome.
$3,000.
Sounds great. Who doesn't want a house for $3,000, right? I'd do that all day long. If the reason I'm doing it is because I only have $3,000, how about this? You put a tenant in. Tenant pays for a month. Tenant pays for 2 months. Tenant pays for 3 months. Haven't got a payment this month. Tenant's ghosting you. You have to file for eviction. That's $1,000. It's going to take you a couple months to get them out of there. You finally get them out. They did $8,000 in damage. You need 12 grand plus holding costs to bring this property current. Where's it coming from? You have no equity in the property, not without a refinance, which if you could have got, you should have already done. And so you've now put yourself and the owner, who's also your lender, in a severely uncomfortable situation because you lack the reserves to deal with this. And that's why it's not foolproof. I would do the deal, but then again, I would have the reserves available that if something went
Right.
wrong, we could afford it.
Which
And
they do. So, I mean,
yeah,
but yeah,
but
you
my
can't,
point is you
there's
can't
nothing
fake no
for free or
cash.
that easy. You really got to pay attention, and you've got to think ahead of circumstances and be prepared for them, is what you're saying.
Yeah, the risks are real, and you need to appropriately account for them. And when you do that, your absolutely amazing returns will start looking more moderate. But that is a much better way to do your underwriting than the opposite. To just pretend the risks don't exist. We're going to make these great double-digit returns, and then you're unprepared when you get hit. And that's how you take losses.
Yeah. So let me ask you, if you were standing up on a rooftop and you had a captive audience and you could give them advice that they would hear and heed, what would your advice be?
This is a team sport. Go find somebody to do this with you.
No one succeeds alone in this business.
No, it's
Impossible.
networking all day long, right?
Build relationships.
It's we extensively teach this because it doesn't matter if you have money or not. However much you have, it's not enough, right? Unless your goal is 30 million and you have 30 million, you don't have enough. And so you're going to run out of your cash really fast. So if you have some of your own money, then I suggest you use it to buy some buy and hold assets in a nice solid situation. That'll give you good credibility. It'll also begin the clock running. The wealth clock starts ticking. We start making money over years, not over days. Then it's not going to be enough. So whether I started out with some money and got to buy some stuff, or I'm starting out broke, I'm going to go out and I'm going to find people who want to build the same thing I'm building.
And you got to be aligned in values as well as goals.
Yep.
Or those can be very challenging situations to try and get out of.
Yeah, that's in our mastermind we teach how to structure partnerships in such a way that
it works for everybody.
Yeah, you start with the divorce and then you work your way to happiness. But you go out and you find those folks and you use those resources to scale. They bring additional money to the table. They get you into assets, and before you know it, you have a large enough portfolio. You can do a refinance. We can pull out some of the money that was put into them. We can use that to buy more, and it starts snowballing. And before you know it, you're a couple hundred into the game in a few years from a retirement at a 8-figure income.
Yeah. Yeah, and it's being consistent day in and day out, week in and week out, learning, implementing. Well, I want to thank you so much, Brian. I mean, I just really admire and respect how far you've come and what you're focused on now. And probably in a year or two, it'll be something else that
I doubt it. The
Yeah.
buy and hold thing is
Yeah.
that's
You pretty
the end
much
game.
hit the pot at the end of the rainbow with that one. But thanks for taking time. I know you're busy, for being on the podcast with me. It'll be in my group, The Unstoppable Real Estate Investor. And then what we do is we post that recording in about 100 other real estate investment groups. So it gets a lot of exposure.
Cool.
We will also be emailing you the clip, the video clip, so that you're welcome to use that however you want to. And,
Awesome.
Yeah. So thanks again. I appreciate it. And we have experts, the top 5 percenters on Wednesdays. And then we go to the other extreme on Fridays and show people that are up and coming. They're learning. They're showing the struggle is real. We have Sevelyn Smith, who will be joining us on Friday to just talk about her journey and where she's at. It's also an opportunity for people to be coached and just to learn and challenge them to take the next step. So, and then on Mondays, we have Mindset and Marketing Mondays with me and Rufus Thibodeau. So that's at 6 p.m. on Mondays, Eastern time. Thanks everybody for joining us. Take action, no excuses, just results. Bye now.
Bye-bye.